Hello, my name is Maria Bezubova and you're at my channel Fertilizers Jazz. Here we talk about events, trends, technologies in the world of fertilizers and agriculture. Please subscribe to the channel, put like to this video, and let's jazz! Today is February 17 and it is a weekly markets update. Let's have a look at the news of week 7 and see what are the next trends. Also, please check out my interview with Mads Frank Markussen, Head of Freight Research and Derivatives at CM Navigator and Navi Merchants, that was published last week. Mads shared his insights about current trends in the freight market and how freight fundamentals work, so don't miss the jazz. Let's move to the situation in fertilizers market. Urea market was on the rise again in the anticipation of Indian tender announcement that most likely will happen later this week. At the same time, US and Australia start active purchasing, Turkey continues to build stocks in front of the season, and Europe still has to cover about 30 to 40% of its seasonal need. Thus, fundamentals are strong and price continued to climb. However, the ceiling looks to be very close. Egyptian producers again tried to increase price for March loading, but managed to do it only by $4. The highest level of sales was $459 FOB. The most significant jump in prices was seen in the Middle East, where value surged to $430–440 FOB, up by more than $10. Taking into account that Iranian production is still out of the market, supply looks really short for March and even beginning of April, with all this simultaneous demand from various regions. Black Sea spot activity was limited again. In the US, barge prices increased by $25 on the back of expected limited availability for March, reaching as high as $423 for short ton. US importers need to fight for volumes with other regions, including India, in order to secure supply in the needed shipment window. Bullish sentiment dominated in the discussions at TFI conference last week. Demand in Brazil is still muted, with warehouses being full and importers comfortable for now. Paper values continue climbing. Egypt FOB showed a significant increase for March and April to the average of $445 and $435 respectively. NOLA values increased to the average of $410 for February, $421 for March, and $408 for April, which is $10 to $15 increase versus a week ago. Arab Gulf FOB stayed at the same level for February and March, however significantly corrected upwards for April to the average of $410. Brazil CFR average increased by $8 for February and remained almost stable for March and April. Ammonium sulfate market was stable to slightly firming last week. China FOB prices for standard product have settled around $151–152 FOB. A sales tender by one Chinese producer was concluded at $151 FOB. Chinese granular prices have softened slightly to $155–160 FOB. Buyers in India and Southeast Asia have stepped aside as these current prices are too expensive for them. In Europe, producers are sold out for all grades and demand will peak soon. Standard product prices at €190–195 FOB, while prices for granular products stand at €255–60 FOB. There is expectation that market prices will go up further with natural gas price rally of recent weeks, as well as nitrates price evolution. There is no time for bringing another fresh vessel from China, so only domestic product and also Chinese product already heading to Europe will be on the table. In Brazil, small volume of compacted product was purchased at high 170s CFR. Otherwise, buying was slowing down. In Mexico, Tepeyac importer has closed the purchase tender for 45,000 tons to the west coast of both standard and granular product. CFR prices are expected to be in the mid-160s CFR for standard and in mid-170s for granular product. In the US, AMSUL price increased again due to tight supply. Price increases in the European nitrates industry continue, as producers seem to be cheered up by the fact that buyers are accepting the new price level. While there is understanding in the market that some price increases were inevitable due to the rise in gas values, there is general concern that producers are surging prices up too much and too fast. LAT Nitrogen announced a €20 per ton increase for both ammonium nitrate and CAN in France and Germany, while CF Fertilizers in the UK and Grupa Azoty in Poland have withdrawn their prices and will announce fresh offers this week. Yara's Ferrara plant in Italy continues to be shut, as maintenance at the plant has been delayed, as per company information. UAN prices jumped both in Europe and in the US on the back of urea and nitrates price increase, as well as high gas prices in Europe, of course. Barge prices at NOLA climbed by $18 per short ton, while European prices showed even more significant increase, by 20 to 25 euros. In ammonia, market prices slipped due to lack of demand west of Suez and building length east of Suez. European CFR price remained unchanged at the level of $575–585, but no new inquiries were heard. Northern African FOB values corrected downwards by $10. Middle East prices dropped more to the level of $310–340 FOB, $15 lower versus a week ago. Spot deals discussions are happening in the even lower range of $310–320 FOB. This is mostly driven by slow demand from India, where importers' immediate needs are mostly covered, and planned maintenance from March-April will limit demand in upcoming months. In the US, spot prices were stable, as well as spot sales in the Corn Belt, in front of the application season. However, some market players expect March barges price to drop by maybe as much as $20 due to the international bearish trend. In phosphates, a new DAP deal for India emerged last week, despite the fact that the subsidy status is generally unfavorable for importers. Ma'aden sold a 60,000 tons cargo at $633 CFR to India's IPL for end of February loading. This is generally in line with prices in India. This could be a result of necessity due to low DAP stocks. According to the latest data, only about 900,000 tons of DAP were in stocks at the end of January. In the meantime, OCP and Indian government are continuing discussion about formula for the supply agreed for 2025. Also, rumors circulate that Purefert is also in discussion of selling 500,000 tons of DAP to RCF. No confirmation though yet. Also seems like Chinese are getting ready to sell DAP to India, but again there is no clarity when and if it is possible. In Brazil, MAP prices remain stable, around $635 CFR. Imports in January almost doubled versus a year ago and reached 283,000 tons, unseen from year 2021. Importers start to prepare for 25-26 soybean application season. In the US, DAP barge was sold at $610 FOB per short ton for March, which marks about $10 increase. MAP prices also climbed on the back of DAP to around $595–610 per short ton for February. Phosphate demand is expected to be strong due to increased corn acreage this year. Moving to the fundamentals. European natural gas futures fell over 8% to around €51 per megawatt hour this week, driven by milder weather forecasts that are expected to reduce heating demand. Warmer temperatures and windier conditions will ease pressure on supply. Additionally, there is growing support for easing EU gas storage targets, with Germany pushing for more flexible rules due to the high costs of filling storage. This comes after EU gas storage sites depleted faster this winter due to colder, less windy weather, and are now about 47 only full, complicating compliance with EU rules that require storage sites to be 90% full by November 1. Also, hopes around potential deal resolving the war in Ukraine contribute to market optimism, as it could ease supply disruptions. US natural gas futures climbed to $3.7 per MMBTU, the highest in 3 weeks, driven by rising LNG exports, lower output, and colder weather forecasts. Gas flows to the 8 major US LNG export plants increased by 5% in February so far, nearing record levels. Meanwhile, extreme cold froze some wells, causing daily gas output to drop. Looking ahead, weather forecasts indicate colder than normal temperatures through February 22, boosting heating demand. Additionally, US utilities withdrew 100 billion cubic feet of natural gas from storage in the week ending February 7, reducing total inventories more than expected. So, short-term bullish trend is in place. Agricultural commodities futures mostly were in green, which of course continues making farmers happy. Wheat futures climbed to more than $6 per bushel, their highest level since October 17, amid strong exports and weather-related risks. USDA's grain export sales report showed wheat sales surged by 45% from the prior 4-week average to 570,000 tons in the week of February 6, driven by demand from Mexico, South Korea, the Philippines, Thailand, and Japan. The fresh February WSD report made some adjustments to estimates, especially in terms of exports. Global wheat consumption rose by 1.8 million tons to a record 804 million, driven by increased feed use in Ukraine, Thailand, and the EU. Global wheat trade fell by 3 million tons due to again lowered export estimates for Russia, Ukraine, and the EU. Meanwhile, traders monitored cold fronts in the US Plains and Black Sea region for potential freeze damage to winter wheat crops. Also, investors weighed US President Trump's announcement of plans for reciprocal tariffs on trading partners. All these factors support bullish trend in the market. Corn futures also increased to the level of $4.96 per bushel. In the February WSD report, global corn production is projected 1.9 million tons lower versus January valuation due to yield cuts in Argentina, where heat and dryness have damaged early planted corn, and Brazil, where slow second crop planting is dampening output prospects. Additionally, WSD forecasts lower corn exports from Brazil, Ukraine, and South Africa, alongside reduced Chinese imports, contributing to a 3 million ton decline in global ending stocks. At the same time, concerns about potential trade disputes, which could weaken demand from US farm products, are adding gloom in the market. So, growing price trend is unstable. Soybean future dropped to the level of $10.36 per bushel amid weak export demand and rapid Brazilian harvest that continued to pressure prices. The latest USDA weekly report showed soybean exports plummeted 74% from the prior 4-week average to just 186,000 tons for the week ending February 6, falling short of the department's projected range of 300,000 to 800,000 tons. Additionally, despite early expectations of a reduction, USDA maintained its forecast for US bean ending stocks in its fresh February WSD report. Moving to the shipping industry. Containerized freight index again corrected downwards by another 5%. The effect of Lunar New Year holidays in China continues weighing on market prices due to decreased demand. Rates for all key destinations between China and US, as well as China and EU, dropped last week. Market analysts expect the rates to drop more in the short term. The Baltic Exchange Dry Index lost the momentum gained a week ago and dropped again. Capesize and Panamax segments were the drivers of this decline due to very slow activity in both basins. It was driven both by supply-demand balance and also some objective reasons like port activity disruption in West Australia due to cyclone, and fire happened at coal terminal in Brazilian port. At the same time, ultra-supramax and handysize segments showed signs of increasing demand both in Atlantic and Asia. To sum up, urea price has not reached its ceiling yet due to strong demand expected in March and April, including Indian, that will be clear most likely this week when tender will be finally announced. Nitrates prices continue climbing on the back of urea price. Sulfate price also increases, but Asian buyers start to step away from the market due to such price level. Phosphates price level is mostly unchanged across the regions. Only US price showed upward correction due to tight supply. Ammonia price continues softening amid slow demand both east and west of Suez, and supply that continues to build up. European gas price significantly corrected downwards after hitting record highs due to arrival of milder and windier weather. Gas price in the US, on the contrary, increased due to growing demand for LNG and colder weather. Wheat and corn future prices jumped after February WSD report showed decrease in expected supply, while soybeans future price dropped amid expectations of higher ending stocks in the US. Container shipping activity was still subdued, and bulk shipping as well in Capesize and Panamax segments specifically. So, let's see what is next around the corner. But it will be already next week. Thank you for watching. Please subscribe to the channel, put like to this video, push the bell in order not to miss any updates, and see you soon.